It's important chapter because you have a project to do, group project. And this chapter 21 will be the last part of the group project, which is the budgeting, master budget. So by covering this chapter, you should be able to finish the group project as soon as possible. For chapter 21, we're going to cover the chapter together, but we have discussions. We have few very good problem video solutions. Definitely watch those. We have 2 homework and few quizzes, and that will be it, right? But if you go to the assignments, that's where you see the group project. So in order to contact your group, you need to go to inbox, write an email to then choose your class, then choose your group, and send an email to every group member. You need to create an Excel document, but it's easier to do with the Google Sheet first and share the link, and then finish the project. Everyone needs to participate and do a portion of the project. One, you need a leader to have an overall look in the project from beginning to the end and make sure that it goes according to the requirements of the project. So just to make your life much easier, I have provided you a sample Excel project that another class once they did. Those people who did this project, they never had such an Excel project sample, and they never had such a luxury. They did it just based on what I told them I want them to do. But in your case, guess what? I'm going to provide you the maximum luxury possible. That means I'm going to give you a sample of Excel project that you are going to make in Google Doc. And after it's ready, you save it as Microsoft Excel, group number, let's say group 2 or whatever. And then the leader will submit the final project into Canvas. Just one person needs to submit it because it's a group project. Okay. So this is the sample, which you can download it, of course, and get advantage of this to some degree to understand the concept that you need to do. So you need to create few tables. As you see, let's say table 1, it's about the material cost. So you have to write here at the top somewhere that what you are making, so everyone can understand, including me, can understand what you are making. A picture of that product, whatever you are going to take it to the production and create this project for. A picture of that product needs to be in the cover sheet of your memorandum, which we talk about that later. But just make sure in the cover sheet, you need to have your group number, group member's name, teacher name, class name, semester, let's say summer 2022 or whatever semester you are. And also a picture of the product that you are going to produce. And here is the material cost, which is table 1, and material cost per unit, bottom line. Table 2 is about labor cost per unit, labor cost per unit. Pay rate, let's say it's $15, or you can make it 20, whatever it is at your state. There's a minimum wage, of course, but you cannot pay below that, and it has to be either minimum wage or higher. And also you have to, in table 3, explain what type of assets you're gonna have for this production, and what would be the total cost of your asset for the 2,500, let's say. Those are all the assets that's gonna be depreciated. So this is the depreciable assets, like machines, furnitures, and computers, for example. Overhead, it will be anything related to production, which you cannot directly trace it to the product easily. So like glue, for example, or utilities or something like that, or rent. So that has to be provided in here, and you have to have, let's say, predetermined overhead rate per direct labor hour, for example, whatever it might be. Fixed manufacturing overhead will be in table 4 also, because table 4 is the variable manufacturing overhead at the top separately per unit, let's say 5 cents, and fixed manufacturing overhead, and that will be again, let's say here total fixed manufacturing overhead is 10,000. By the way, this project is done by students. I'm not saying this project is 100% perfect, but it is good enough for you to get the idea. Make sense? So there are some issues here and there, but overall it's a good project, so you can have a good idea about what you want to do. That means not everything in here is correctly done, but it's good enough. Okay, remember that. Again, in table, so that was table 4, which is variable manufacturing overhead and fixed manufacturing overhead. And then in table 5, it says about selling and administrative expenses, like period cost. And again, the period cost, selling administrative expenses, operating expenses, so-called, they are also some of it variable, some of them fixed. You need to also identify what is variable and what is fixed selling administrative. So you have to show them separately and also per unit that you're going to produce, how much is per unit. Fixed and variable cost. Table 6 is a summary of the other 5 tables. So in table 6, you show all your variable costs in one section, starting with direct material, direct labor, variable overhead, and variable selling and administrative. So I did show you here where are these numbers are coming from table 1, table 2, table 4. So all this stuff needs to be linked. Make sure you are using Excel, okay? So every single information, let's say coming into table 6, has to be linked to the proper cell at the top. So don't forget having link in your project. A project without link, it's like piece of paper, is not Excel anymore. And that's not acceptable. And I tell you why it's not acceptable, because imagine this is a real work. You are in a meeting and you are, presenting your budget, and the committee members, they, ask to change something in the budget. You cannot tell them, oh, because I didn't link anything in here, so things that you want me to change takes another 2 months to do it. No, because everything is linked. Any change, it takes about 2-3 seconds to do. Because as soon as you change it, the whole budget will change. Because everything is linked. And I'm going to do the same thing, of course. I'm going to, let's say, you say direct material, for example, here is, for example, what? $2.21. I'm going to, let's say, change this direct material cost to another dollar, let's say $3. And I'm going to click enter. And I'm going to go ahead to your project to see that change of direct material to $3 has been, has been updated in your project all the way to the end, yes or no. If not, then that means your project Excel is not linked properly. So you can test the same test ahead of time before you submit. So here in table 6, as you see, we summarize all the variable expenses, and also we summarize all the fixed expenses. And here is the second part of the project, which is cost volume profit analysis, which we learned already. So you have to provide some type of cost volume profit analysis in here, including the ratios, contribution margin ratio, per unit, dollar amount, net income for each unit of production, what is your possible selling price, what you're gonna sell, let's say $35, $36, whatever you're gonna sell it, let's say. So that's the information, and then you go to break-even points in sales, and then break-even point in dollars. Then you go to target sales. You have to say what is your possible target profit for the first year of your production. You might say $100,000, $50,000, $1 million, whatever your target profit is. And based on that target profit, you have to calculate the target sales and target units. Of course, when I click on these cells, I can see all the formula in the Excel. And I can see how you came up with this 6 point whatever, let's say $1 million, or here, whatever is 178,000. How do you get that number? As soon as I click on the cell, I can see the formula in the link in the Excel. And I can see how you are calculating that. And here is the, let's say, target sales. And if you sell this much, you have that much variable expenses. That's your target sales unit. The fixed cost is, let's say, 388,000. So I just want to review, see where is that 388,000 coming from. 388,000 coming from here per year. You see that number right there, 388,000. Okay. Like here says per month, like this part, honestly, we don't need it. Like this part, that's why I said this project is not perfect. Like per month, what do we need per month here? Yes, we need the whole year. Yes. Do we need the per unit? Okay, yes or no, but why do you need per month? We're not gonna create a monthly base budget anyway. So this per month part is, I don't know, useless, right? You see here, useless. Okay, but extra information, that's what I'm saying. Okay, so let's see what else is here. Oh, margin of safety has been calculated here, and margin of safety ratio is like 91% margin of safety ratio, and that's margin of safety dollar sales, that they can lose the sales dollar up to that amount and still break even. And then here is the budget. So the master budget starts with sales at the top, and sales, those are your estimated percentage of sales, okay? Unit sales percentage, those percentage of sales, it's up to you, depends what you are producing. Let's say if you are making ice cream, let's say in quarter 2 and 3, you will have a very good high sales percentage. But let's say in quarter 1 and quarter 4, because the weather is cold, you sell less ice cream. Make sense? But if you are producing, let's say, jacket, so jacket in quarter 2 and 3 will sell less, and in quarter 1 and quarter 4 probably you will sell more. Most probably quarter 4 will be your busy time, I think, because it's cold on quarter 4. So bottom line, this percentage is based on your estimate of sales in regards to the product that you're producing. So you have to have a sales budget first, and then everything else can happen. So the next thing, let's say you go to schedule of expected collections from customers, for example, that's a budget by itself. They did it in here. And in regards to making this easier, I want you to use this policy, which is this thing that here is typed. So in our project, we are going to assume that every sales that we have, 100% are collected in the quarter sold, just to make it easy, okay? So all your sales are collected in the quarter sold. So you don't have 30% collection in the quarter and then let's say 50% collection in the next quarter and then 20% collection quarter after that. That will be a little bit more challenging. So it's just make it easy at this point, 100% collection in the quarter sold. Okay. And then here is the production budget. Again, production budget is based on how much you're going to sell, of course, and then how much percentage you need to have. So you can use also the same thing. 10% of the next quarter unit sales you need to have in the finished goods unit. Okay, so go with that. And that will be your production budget. And then ending inventory budget, let's say here they did something, as you see. And keep going. They have direct material budget. And again, for direct material budget, we go with that 10% assumption of need of direct material for the next quarter production. So go with 10%. And then for cash disbursement budget, here you see that how much cash you are going to disperse in each quarter. So your budget will be based on quarter, remember that. And this is a brand new business. So you didn't have any accounts payable from before. It starts from January 1st, a brand new business with a brand new production. So there is no accounts payable from last period, or there is no accounts receivable from last period. Okay, there was no last period. Everything starts brand new business. And because it's a brand new business, you don't have accounts payable already. You don't have accounts receivable at that point from last period. And also you need to raise capital for this new company and the new production. That means you have to issue stock. So remember, when you are preparing your balance sheet and financial statements like income statement, this is a new company and you need to establish and raise capital by issuing common stock. And you can borrow some capital from a bank if it's necessary. So make sure whatever you do, your balance sheet is properly showing that. So here is direct labor budget again. Okay. And here is the manufacturing overhead budget. Here is the total manufacturing overhead. And here is the, let's say, direct labor hours. And as you see, this is predetermined overhead rate in here showing. Selling administrative expense budget, that's the period cost, right? So that's a budget by itself, which has variable part and fixed part. So bottom line, that's a budget by itself. And cash budget again for 4 quarters. And here, if you don't meet the minimum requirement, you have to have a minimum requirement. And if you don't meet the minimum requirement, that means you have to borrow. If you borrow here, then your interest rate will be 10%, and the borrowing will be paid as soon as there are enough cash available. So you pay the borrowing plus interest in the next period, if the cash is available. If not, then you have to keep that, borrowing still on the file till the period after that. Okay, so here is the budgeted income statement. Looks like 100% sales, and what's the gross profit ratio, and then the net income. And as you see here, the net income is $4 million almost, right? And if you remember, the target profit was $4 million at the beginning. So here, this $4 million needs to match the target profit that you stated at the beginning of cost volume profit analysis. Make sense? And as I see, they are matching that. You can be $1,000 more or less, but you have to be at that target profit that you stated before. And this is the balance sheet here. So this cash balance, let's say 4.9 million, has to match the cash budget over there at the top. Accounts receivable, again, we didn't have any because, as I said, whatever you sell in the quarter will be collected in the quarter. So your accounts receivable will be 0. Same thing about accounts payable will be also 0. But you need to show what is the finished goods inventory balance, which comes from the budget of productions. A raw material budget has to match with the raw materials that budget that you have at the top. And then it shows the current asset, which is good. And then you show your equipment total, which is coming from the cost volume profit, from the first tab in regards to, I believe that was table, maybe table 3, I believe, in the first tab of cost basis. So that's 42,000 total equipment. And here shows the accumulated depreciation. And accumulated depreciation is based on combination of all this equipment, and use 0 salvage value and 5 years useful life, straight line method, and make sure your depreciation shows properly. And that shows your net PP&E plus the current asset that you have, and that's your total asset. And then liabilities looks like there's no accounts payable anyway, because you always pay in the same quarter, but you might borrow some money, and that will be a note payable. If you have any, it should show in here. Common stock here, as you see, these people raised $1 million of common stock. And as you see, the common stock is showing for $1 million. The retained earning is technically beginning retained earning, which is 0 because it's a new company, plus net income, okay? Minus dividend, which they don't, we don't issue and declare dividend. So it will be technically retained earnings will be, in this case, equals to net income right there. So retained earning is beginning retained earning, which was 0, plus net income minus 0 dividend. So ends up to be net income. And then add them up, it's 5 million here. And that will be equals to liability plus equity. And that will be total 5,297,600. And here is 5,297,600. As you see, balance sheet is properly balanced in here. Okay. So this is a very good sample project for you to take advantage of it, to look at it, so you have a very good idea what you are going to do. So here is a sample project. Here says that you have to work with the group to do it. Here says that in set 1, you have to have one tab in your Excel sheet called cost basics. And then you, in this cost basics, you have to explain the cost basics through table 1, 2, 3, 4, and 5. Table 5 is combination of all those above tables, which is put them in the variable cost and fixed cost combination. No, sorry, that you do that in table 6. So through table 1 through 5, you show all your costs, including material, labor, overhead, and selling administrative. In table 6, you just round them in one table by separating them in a variable and fixed sections. Okay, so in tab 2 in your Excel sheet, you have the CVP analysis, you call it. And in that, you need to have all these requirements properly calculated. And then you, in set 3, you create a tab called master budget. In the master budget tab, you will have all these budgets prepared. Now, you can create a tab for every budget if you like that way, which I like it that way because I can easily, click to one tab and go to the next tab and the next tab, easily move from one budget. So instead of having just one tab called master budget, just create different tabs for every one of those budgets, which is sales budget, which you need at the top, and then production budget, ending inventory budget, selling administrative expense budget, direct material budget, labor budget, overhead budget, and then cash budget, and then finally budgeted income statement and balance sheet. In regards to memorandum, you need to write a memo. Here is a sample of memo, so you can have a good idea about it. So in the memo, first, your company name is your group name, like group number. So if, let's say, group 4 production or something like that. And you need to write a business memorandum. And what's requested in the memorandum, the question is here: budgeted profitability of the first year of the production. So in regards to profitability, you have to write a memorandum to the board of directors, and there is a sample memo here to tell you how to write it. So in a memorandum, you need an introduction, a body paragraph, one body paragraph for each issue. Here you have just one issue, so you just need to write one body paragraph, and also a conclusion that says what happened in the body paragraph, in a summary form. And also there is a sentence at the end of the memo that says, please do not hesitate to contact us for any further information. And that's the last sentence, and your memorandum is complete. So you can look at the memorandum to see how it looks like. So here is the memo. It says group 4, let's say toy manufacturing. That means this is coming from the group 4. Here is the picture of the product that you are producing, which is good for you and me to see the visual picture. And here you say this is group 4. Those are names of your group members. and that's managerial accounting. That's the date, semester, and that's your teacher's name. And this memorandum here has to be honestly on the next page. So this is kind of an issue. So this memorandum needs to be on the top of the second page. And board of directors, you have to write 4 things, 2 from subject and date. So here, 2 board of directors from the, let's say, group for toy manufacturing accounting department, let's say, and regarding or subject, whatever it is, like profitability, and then date. And then the first paragraph will be your introduction, why you are writing this memorandum and what was the requested issue. And then in regards to the issue, you have to come up with some explanations and some ratios, let's say profitability ratio, return on asset ratio. So you have to bring 1 or 2 ratios. And also you have to show your net income dollar amount, let's say here $4 million or something. So you need to have dollars and ratios to prove your point. And then in the summary, you have just to wrap it up what happens in here. And then the last sentence, which says, please do not hesitate to contact us for any further questions or concerns. And that will be your memorandum. So that's your memorandum. Memorandum has to be written at the top of the page, not here. And then you need to have a cover page. Okay. Okay, so that was a good overview of your project, which is a very good project. The project is so good if you do it perfectly, to the point that I remember one day a student emailed me, said, hey, I took your class 2 years ago and we did a very nice project. And that project was so like good and usable. And now we are actually having a business going on, brand new business. And I need that project so I can kind of use that project as a template for my business that we are creating right now. But I don't find my file. Do you have that file maybe available in your system somewhere? And I remember that group did a very good project. So I kind of kept that file by chance in my flash drive. And I asked him what year was that, what class was that, what group was that. So somewhere, somehow I was able to find it. And he was so excited to have that, his own project back again, because he's gonna implement that project as a very good platform for the new business to create something like that for their production and the business that they are going to establish. So this project can be a very useful project in a real life scenario. Okay, so enjoy it, and do your best on this project. Okay. So what I'm going to do is go to the chapter 21. In chapter 21, first few parts are just for you to read and just reading materials and understanding what budget is. So you can just go and read through those definitely before you do anything. So read those and let me go to somewhere that I can explain the technical part of it. So here is the budget committee that explains what budget committee do. And here there are some type of budgets that you can create a top-down budget. That means the top management tell to lower employees, managers, what type of budget they want. But that by itself has its own problems, right? Because top management, they don't know exactly what's going on underneath. And this is a very good picture. So they push the budget from top to bottom. But there's another one that here says bottom up budget. That means the lower management, they create their own budget and they push it upwards to all the way to the top management. And of course, they have to agree on that budget and do some minor adjustments here and there. And here is explaining how the data is flowing, budget estimation. It's talking about budget slack. Budget slack means sometimes the management, they try just to match the budget and just not to estimate a very high budget so they cannot reach it. And also when they reach to the point, they don't want to go over that budget in regards to creating revenue or something, because they might think, oh, the next year they're gonna ask us to do the same thing again, and then we get in trouble. Zero-based budgeting is about, I believe, telling that where these expenses are coming and you have to justify those budgets. Anyway, so those are all technical, not technical, but I mean reading materials for you. But let me go to see if I can see a little bit technical stuff so I can go over those budget. Yes, so here is the master budget, which is known as comprehensive budget, an integrated set of articulated budgets relating to numerous operational subcomponents, which is labor cost, material cost, overhead cost, selling administrative cost, and those type of things that is in the budget. So the first thing in the budget unit is the sales budget. So you have to estimate what type of sales you're going to have in every, let's say, quarter. And because of that sales estimation, you can then say, oh, okay, because I'm selling this much, then I need this much production. And because of this much production, I need that much labor, material, that much labor, and that much overhead. And also because I'm going to sell this much, then my selling administrative expenses would be probably that much. So by having a sales budget, you can create the rest of it. So sales budget is the first thing you need to do. And after all these budgets are ready, then you can combine them and you create a budgeted income statement and balance sheet. So the company's budget committee and the management can look at the next upcoming year budget and see what they're gonna do, where they're gonna end up, and how they're gonna implement this budget into reality. Okay, so here, as we said, the sales budget is the first budget, which is a budget that details anticipated sales level at a, let's say, monthly basis or quarterly basis. So here is a very good example for you to utilize this as a sample for a sales budget. So you need to create a sales budget in your group project for quarter 1, 2, 3, 4, and annual recap. So here is the estimated units that you're gonna sell in every quarter, and here is the cost sale price for every unit, which you have to estimate what will be your selling price for your production in the group project, and you will get the estimated sales. Then using estimated sales dollars, you can come up with expected cash collection from sales, which is the next budget for expected cash collections. And how much you're gonna collect cash, that depends on your business. In your project, you will have collection for every single sales in the quarter, your collection will be totally collected, 100% collected in the same quarter. But here in this example, you might say, oh, you collect 2/3 of, let's say, sales in the quarter, and then 1/3 in the next quarter. So 2/3 in this example, 2/3 is collected in one quarter, and the next 1/3 in the upcoming quarter. So here is first quarter, you are selling $367,000, let's say, right? And so 2/3 will be collected here. And let's say from prior quarter sales, it will come like $100,000 here. In your project, again, one more time, you don't have prior sales. This is the very first year you start. So your prior sales will be anyway 0. And again, to make it easy, we assume you collect 100% in the same quarter. So here shows the cash collection for, let's say, quarter 1, and then cash collection for quarter 2. So quarter 2, let's say you collect 2/3 of quarter 2 and 1/3 of quarter 1. So this sale, $122,500, came from quarter 1, which is that number, times 1/3. 1/3 of that number goes right there. 2/3 of that number goes in quarter 1. And in quarter 2, 2/3 of $262,500 goes as a collection in quarter 2. 1/3 of that goes in quarter 3. So you got the idea, right? And here, as you see, there is tab in the Excel for every budget separately. That's the way I ask you also to do for your group project. So here is a very good example of that. So for production budget, which is a budget that details planned level of production, takes into account sales and inventory build. Okay, so here we go. This is your production. You are estimating that you're gonna sell 2,100 units in quarter 1, 1,500 units in quarter 2. Those numbers are copied from here, okay? So here you can type, but if you type here once, anytime you need these numbers again in the project, you need to copy it. You never type it again. Make sense? So for example, here I go to your project and I say estimated sales here, for example, is, 2,200. So I can just change this number and enter it and see if the project has been updated or not. And also, you see here the recap here says 9,000. That number in your project, technically that number comes from your cost volume profit analysis, where it says target profiting. So wherever you do target profiting in the cost volume profit analysis tab, this number right there equals to the target sales, that sales profit that you have in cost volume profit analysis. And then first quarter sales is equals to this number times a percentage. Let's say 24% or 20% or 10% or whatever it is. So one more time, this number comes from your cost volume profit analysis tab, where you find your target profit units, okay? And these numbers in here, quarter 1, 2, 3, 4, is a percentage of this annual. Okay, so technically don't type this or this or this or this or even this. All these numbers, this one comes from the cost volume profit analysis tab, and the rest 4 quarters sales unit comes from saying equals to that number times a percentage. And the percentage, again, depends what you are selling. I don't know if it's an ice cream or t-shirt or jacket or whatever, depends on the quarterly demand, right, in the market. So bottom line, as you see here, again, these numbers are copied from sales budget. And in the production, you have also a desired ending finished goods, let's say 10% of next quarter unit. Here says 25% following quarters unit. So in our project, we do 10%. So 10% of second quarter. And this is your desired finished goods. So you need 2,100 units, but you want another 375 units as a form of having a secure finished goods inventory for the next quarter. That gives you total need of 2,475 units need for quarter 1. But in this example here, you have previous beginning finished goods. But remember, in your project, this beginning finished goods is 0 because it's a brand new company. So don't forget that. Okay. So bottom line, 2,475 minus beginning. Then you need to produce, let's say in this example, 1,950. And you repeat the same thing for quarter 2, 3, 4, and you have your annual recap. Direct material budget, again, you need to create for understanding how much expected direct materials are and how much you need to purchase. So direct material budget comes from scheduled production. So here you copy it from that line. See, scheduled production, you copy that line into here. So now that you know what is your scheduled production, then you have to see, okay, how much raw materials do you need? In your example, you don't need to put the materials per unit square feet or something like that. I suggest just start from here, say how much will be the cost for later, just like this. You see here says estimated cost per unit. So, so keep that cost part later on here. So here you need scheduled production. Let's say 1950. This is the direct material. Let me show you the example here so you can kind of see what I mean, just to make it easier. Okay, we're trying to make it easier. Let's see how it goes in here. Okay, keep going. Production budget. So you know that those are the production budget in units. You copy that into, let's see. Here is direct material. Here is the production unit. You see, you copy that in here, right there. Okay. And direct material per unit, Let's see what they did. Desired ending direct material. This is desired is the 10%. Remember, here, you remember here we said 10%? They went with the 10%. So they said, okay, we need this many, let's say direct materials, because your direct materials might be different materials, okay? Whatever it might be. You have it in what you exactly need as a direct material. It is right there, you see? So you have all these direct materials, a little bit of this, a little bit of that. So just to make it easy, so you say, okay, this is the direct material that I need, and this is the cost, $2.21. Got it. Okay, so keep that in mind. And now you go in here and you have the production budget in units. Very good. You pick them up. You copy it into direct material budget right there. Okay, you copy it there. And then you say, okay, we need this much direct material budget unit to be produced. And we need one direct material per unit. That one came from technically from those bunch of things that you need, right? And right now here we say just one, just to show that direct material overall as one unit. So you need 47,195 units of direct material. And also you need 10% of the next production, 10% of this into here as a desired ending for direct material. So total direct material will be 51,647. Because this is a brand new company, so your direct material beginning was literally zero. So direct material purchase should be for 51,647. Right? This is unit of direct material purchase. And we know based on that table 2, I believe, we just look at it, it was $2.21 total cost of direct material per unit. Yes, it's not just one piece, it's several pieces, but overall it's $2.21. So since we need 51,647 units of direct material times $2.21 cost of direct material, again, came, you don't type this in here, okay? These numbers, you see those costs? Copied from the table 2, okay? And then multiply that, then all of a sudden you have direct material purchase cost for quarter 1, 2, and 3, and 4, and the combined. Okay, so this is how you can make it easier for your production. And in a real life, yes, what is that one representing in regards to direct material? That one represented in the direct material, this is the cost. Yes, this is the cost, but what you exactly needs to buy if you are material purchase manager, then you go in here and you say, okay, this is what I need for every unit. And this is the cost. You need this much of these parts, and total, that's the cost. Okay, so that was the idea. Now here, here they went like per square feet or something. So how much? Imagine it's just one thing. If it's just one thing, then you can say, oh, square feet. But normally you need more than one thing. So that's why you have to leave the details somewhere else in that table 2 of your group project. So here you can just leave it 1 as I was explaining. But here it goes with the square feet, which is fine. So it looks like you need 68,250 square feet of direct material. And your target raw material is, let's say 20% of the next quarter need. So in this example, so 20% of that. Next quarter need is 13,000, 20% of 65,000. And total now you need 68,000 plus 13,000, which is 81,000 square feet of direct material. And again, the target beginning raw materials here was 13,650 given to you, but in your production group project, it's 0 because you started fresh. So you find out how much materials you need, and then how much is the cost of the material, and how much is the total cost of the direct material purchase for quarter 1, 2, 3, 4, and combined. So now that you know how much direct material you need, you can create an expected cash payment for material purchase. We did same thing here, expected cash payment for cash collection for sales. So now we have expected cash disbursement or payments for material. So it looks like we're gonna have this much raw material purchased, and we, again, in our project, you pay all of them 100%, okay, at the same quarter. But in this example, it says the company is paying 80% in the quarter and 20% next quarter. That's fine. So 80% of 94,000 will be paid in here. And then you pay 20% of the previous quarter. And that's your total payment. Here you pay 80% of 101, 20% of 94, and 20% of 101 goes to the quarter 3. And this way you can calculate how much cash disbursement you have for material. And that's where the material tab is. The next tab is labor, and then overhead, and keep going, right? So that's what we do. Now you go to labor. So labor, it says your production is that many, comes from the production budget, that many units. And then you need some direct labor hours. It can be few minutes, it can be 1 minute, half a minute, less than half minute, whatever, 10 minutes, whatever it is, it should be in here. And then you calculate total direct labor hours needed for these productions every quarter, and how much you are paying for direct labor hour. Again, I said you cannot pay below minimum wage, so make sure you know what is the minimum wage for the state that you are producing, and you put the minimum wage or higher. And then cost of direct labor will be calculated by multiplying for quarter 1, 2, 3, 4, and combined. The next one is manufacturing overhead. So for manufacturing overhead, you might have like direct labor hours, that, you know, how many direct labor hours you are gonna have here. You see that? And then you multiply that by variable factory overhead rate. Variable factory overhead rate, let's say, is $5 per direct labor hour, because that's variable. Let's say in this case, they are separating the variable and fixed. So variable manufacturing overhead is, let's say, $5 per direct labor. That gives you total variable factory overhead. And this variable factory overhead comes from table, gosh, let's see. I tell you. Give me a second. Here from table 4. So in table 4, you have the variable and fixed overhead. So that variable manufacturing overhead comes from table 4. That's where it's come. So that will be total variable, and then fixed factory overhead. Here, fixed factory overhead comes from table 4 again, bottom portion of table 4 for the fixed overhead. Again, you see here, table 4. So that's the variable, that's the fix, and total, less depreciation. Remember that, very important. The depreciation, it's non-cash expense. Yes, it's an expense, but it's a non-cash expense. So make sure that depreciation is not part of your overhead, because here, when you are talking about overhead, right there, right, there is a fixed overhead, and in the fixed overhead, there is the depreciation of your equipment, part of the fixed overhead, right? And that depreciation has to be deducted. So, because it's a non-cash expense. So total factory here shows 82,000, but minus the non-cash depreciation expense recognized in the overhead already. So your actual cash disbursement for overhead will be 79,300 in this example for quarter 1. Okay. And here is predetermined overhead rate is $13 technically. And how they calculate that predetermined overhead is the total manufacturing overhead estimated for the year, that number, divided by total direct labor estimated for the year. And that gives you the $13 predetermined overhead rate overall for this company. Then you go to the next tab, which is finished goods. So click on that. And then you have the finished goods. Here is a good template. So finished goods is the company name at the top, ending finished goods inventory for the year ending December 31st, 2022 in your project, let's say. And here is the direct materials that you need, cost, direct labor cost, manufacturing overhead, and add them up. Total cost per unit is $13, let's say $130. And here is the number of units in the ending finished goods inventory, which is 700 units left, which is 10% of, let's say in your project, 10% of the next year. And right now you should ask probably, okay, what is my next year first quarter production? Okay, for your group project, the next year first quarter production will be exactly same as your first year. So you're not going to change anything, let's say. Okay, so in that way, you know what is the next year, second year, first quarter production, because you need to know number of units that you want to have in the ending finished goods. And here is the ending finished goods inventory, the dollar amount. So $130 cost per unit times 700 units at the finished goods inventory. And that gives you the ending finished goods inventory of $91,000. That number, remember, that number goes into balance sheet. Okay. balance sheet. You click the next tab, which is selling and administrative. And in this tab, you have, again, 4 quarters. Estimated units sold comes from the sales production, copied from the sales production budget, and multiplied per unit variable selling administrative. Again, variable selling and administrative comes from table 5. Okay, table 5, variable cost. So that's the cost, variable cost, and that gives you the total variable expenses for selling and administrative. And also selling administrative has fixed expenses, which those numbers comes from, again, table 5, fixed cost. And then that will be your total fixed cost. And that will be the total budgeted selling and administrative expenses for quarter 1, 2, 3, 4, and annual. And remember, this annual budgeted selling and administrative expense, it will be in the income statement in the operating expenses section, okay, below gross profit. So if I look in the income statement, I have to see this number over there. Cash budget. Again, cash budget, let me show you one. Here is a good template. So again, quarter 1, 2, 3, 4. Beginning cash balance. Be very careful here. This is what's going to happen. What is your beginning cash balance? In your project, the beginning cash balance will be exactly equal to common stock that you issue. Okay, you need to issue common stock, right? So that, let's say you issue $1 million of common stock. If you issue $1 million of common stock, so that beginning cash balance will become $1 million. If you are issuing 100,000 common stock, $100,000 worth of common stock, then your beginning balance will be $100,000. So whatever is the beginning cash balance in here needs to be in the budgeted balance sheet, in the common stock section. Make sense? Common stock section, that beginning cash balance has to be in the common stock section. So if you look at this project, let's see if it's good or not. So in the sample project I gave you from students, I'm gonna look at the cash budget to see if they did good job or bad job, okay? Here, you see this beginning cash balance of $1 million. Where is that money coming from? From issuing stock. That's where it's coming from, because it's a brand new business. How come you have $1 million, right? If you don't want to do it this way, you can say, okay, beginning cash balance is 0. Then here add another line and say issuing common stock, and then put $1 million over there. That will be much better than this, okay? So that's a good idea. So start with 0, beginning cash balance 0, and then here add another line and say add issuing common stock, $1 million. So that will be exactly showing where that $1 million is coming from. And then you go to the balance sheet. Here in the common stock, you see that number is equal to that number there. Got it? So here is the cash budget again. So this is the beginning cash balance plus customer collection that comes from sales budget. Okay, these numbers are coming from sales budget. And then available cash, add them up. And then disbursement. This comes from direct material budget disbursement. Labor comes from direct labor budget disbursement. Factory overhead copied from the factory overhead budget. Selling administrative expenses comes from selling administrative budget. So all these numbers are copied from those budgets. Taxes, here, let's say is paid, whatever is paid. For your example, you can just avoid taxes. That's fine. You can avoid taxes. Let me look at them, see what they did in this budget. Yeah. So you can avoid taxes for now. So just show net income and no taxes here, assuming there is no tax. That's fine. Just make it simple. If you want to show taxes, you can show taxes, let's say 20%. Normally that's 20% of your income, corporate income goes as form of taxes, let's say. If you want to do it, it's fine. If not, you can optional, just ignore it. Equipment purchase, remember, all your equipment purchase will be in the first quarter. Equipment purchase, all of them in the first quarter. And here shows total disbursement. And then here shows the cash surplus. So here is the available cash minus this disbursement, then you have surplus. If the surplus satisfies your minimum required cash, you should have a minimum required cash. So make sure somewhere in the cash budget, at the bottom somewhere here, say what is the minimum required cash. So if this 82,000 is satisfying your minimum required cash, then you're fine. You don't need to borrow anything. If you don't have enough cash and you are in deficit, then at that point you need to borrow. Like this example, you have to borrow. And if you borrow and then you have additional cash available, then you need to pay it. Okay, you have to pay it. So, but you can pay only to the point that you don't go below your minimum required cash. Okay. And if you pay, also you need to pay for the interest. So here there's an interest payment, let's say $3,000 for this borrowing. And then the end cash goes to the next quarter. So if you see that 3,154 goes to the next quarter right there. Yeah. So I want you to spend a little bit of time and look at this cash balance and go from top to bottom so easily you can see what's going on. So it looks like here, for example, the minimum cash balance is $3,000. So because they are not below $3,000 here, so they can easily pay $75,000 of repayment and pay the interest for 1 quarter. And the quarter is 3 months. So this is the interest only for 3 months. But they have, if they pay $75,000 out of this, still they have $75,000, let's say, payment that needs to be paid in quarter 4 or later. Okay, now you go to income statement and balance sheet, budgeted income statement. So this is the budgeted income statement for the year ending December 31st, 2022. Sales, whatever it is, comes from the sales budget. Cost of goods sold comes from the beginning finished goods, which is technically zero. Cost of manufactured goods manufactured comes from production sheet that's manufactured. And zero plus cost of manufactured gives you the available, let's say, in your group project. Minus ending inventory balance gives you cost of goods sold. Now cost of goods sold minus sales gives you gross profit. Gross profit minus coming from sales administrative budget, 206, gives you the income before interest and tax. And then this is like operating income. And then you have interest and tax after that. So interest is 7,500. So income before tax will be 195, 191,500. And then they have a tax, let's say, I don't know, 20%, 30%, whatever it is. And that is the coming from the cash budget. If there's income taxes, comes from the cash budget. And that gives you the net income. Again, having income tax, it's optional. If you want to do it, make it 20% of income. Okay. And now you have net income. That means you have to create your balance sheet. In the balance sheet, again, your previous year is zero. Remember that? There was nothing going on. So in the year that you are preparing, your cash comes from the cash budget. Accounts receivable for your project will be zero, but here comes from, again, sales sheet showing accounts receivable. Raw material inventory comes from material budget, whatever you have. Finished goods inventory comes from ending finished goods inventory budget that you have. At the top, you will see that's finished goods inventory. And also, that's your current asset. And then you have PP&E, which is property, plant, and equipment that you purchased already in Q1, less annual depreciation. And for annual depreciation, use straight line method, 5 years useful life, 0 salvage value. Okay. And that will be property, plant, and equipment net. And then add them up. That's your total asset, as you see here. And then accounts payable, if you have any, but in your project will be 0. Interest payable, I don't know, depends on your project. Some people might have it, some people don't. Note payable, if you have it any, obviously, it should be there. And then you have total liabilities. And then equity, that's common stock. As I said, that comes from the beginning cash budget. Okay. And then retained earning. In your example, I said beginning retained earning plus net income minus dividend. Beginning retained earning is 0. Net income, it is whatever it is, minus 0 dividend in your case, in your project, and that will be your retained earning. And then transfer common stock plus retained earning here, and then add them up, and that will be your total liability plus equity, double line, $ equals to total asset. Cool. If you have any question, let me know, please, okay? Let me see if there's anything else. Okay, so budget is normally for next 12 months, but you can have a continuous budget. That means you constantly add another, let's say, quarter or another month to the end of the budget when 1 quarter or 1 month is finished. So imagine this is a quarterly budget. Let's say as soon as 1 quarter is over, you create the next quarter. In your project, I said your Q5, which is year 2, Q1, will be, assuming will be the same thing as the year 1, Q1. So just to make it simple. We have also two types of budgets. We have a static budget. That's what this is. The static budget is exactly what you are doing. It's your actual budget, a budget that does not anticipate alternative outcomes. You say this is what we estimate, okay, based on estimated sales and expenses, which are either fixed or variables, and that's what you do. That's your project technically. But in reality, it's not going to happen exactly what your static budget is saying, right? When you prepare a static budget, in future, you have to get a very close look into actual what happened, and then compare to see if you are doing a good job or bad job, okay? But static budget will be useless. So you have to use your static budget to create a flexible budget, which is very, very almost identical to the reality that happened, okay? Because when you were creating static budget, that was 12 months down the road. Now, 12 months later, you know actually what happened. So based on you know actually what happened, you create a flexible budget, which is a budget that covers a range of potential outcomes by relating expenses levels to the potential revenues. And one of those potential revenues has to be exactly what you did in a real life. And then by using that real life flex budget, then you compare to real life results of sales and production, and then you can see if you were up to your budget, you missed your budget, you made a mistake, you did poorly, you did very good, and to assess your results and do better next time. Okay. Okay, that's about it. That's chapter 1. Okay. Any question, please? Let me know.
I do have a couple questions regarding the group project.
Mm-hmm.
So my group is group 7 and we only have 4 people.
Okay.
Is there going to be something different, or
no?
Should we still?
No.
Okay.
I want to give you the taste of working with a group. Otherwise, I could have tell you do it alone, which is much easier. But I want to have 5 people or 4 people or even 3 people, so you have a little bit headache to work together, because everyone has different attitude, different timing, and everything is different. So it's going to be harder if you have 5 people. It's going to be a little bit easier if you have 4 people or less, because technically the easiest way is this: let me do it alone. And that's the easiest way, because you sit down for 2-3 hours, 4 hours, get it done, finished. You don't need to talk to anyone. But I want you to learn to work in a group, and specifically remotely in a group. So I had projects in my second master program, which was an MBA program. It was fully online. My group members, they were from all over the planet, from Europe, Japan, Southern America, you guess, whatever you might think. So what I did, I took the responsibility as a leader of the group at the beginning. I created the Google Sheet, and I gave the access to the Google Sheet to all those people. I said, this is the link. If you click on this, you will have access to it. And I want you to choose what you want to do. But technically, I separated the project into 5 pieces, or if you are 4 people, 4 pieces. And then I chose, let's say, part 1 or part 2. I'm going to do that one. Please choose your part, and let's get this done, and let's finish it. and we might need to have a Zoom, let's say, for half an
Mhm.
hour or so, maybe once or twice, just to make sure that everyone is on the same page. So bottom line, one of you guys needs to take the leadership role and create the Google Sheet, and you work remotely.
Uh-huh. Okay. Okay. A follow-up question. What if one of our group members isn't really like doing anything?
Yeah. As I said, there is a link that it says how to access your,
Mhm.
how to contact your group members. I believe that link is here, using inbox. You
Mhm.
normally email that your group members, let's say twice or every other day, 3 times. And
Uh-huh.
after 3 times, if just 3 people are responding and the other one is not responding, then
Uh-huh.
just email me. Say, hey, you know what? We are in group 2 in this class. I already, in last 6 days, I already emailed every other day. Everyone is on board besides this one individual. And at that point, I will email the whole group, including that individual, one more time. I say, hey, this is your last time to respond to this group. Otherwise, you are out of this group and you will be dismissed from the point of this group project. And that's it. That's it. I will take that individual out. You emailed them, let's say 3 times every other day. I emailed that the whole group member, including that person asking to respond. He didn't respond. He's out. I will take
okay.
out of your group and you will remain with 3 people or 4 people or whatever.
Okay, okay. I just wanted to make sure because I did reach out, but one person didn't respond yet. So I'll follow up with them.
Yeah, just do a follow-up so we have a good reason. Say, hey, we follow up with you already 2-3 times. You didn't respond. And here we go. You're out. In a real life, you are fired from the company, bottom line. Because if you cannot work with the group, then you're fired. But in our class, you are just out of points, out of group, and you lose your points.
Yeah. Okay.
Yeah.
Yeah, that's it from me.
Sure.
Thank
Very
you.
good question. No problem. Okay. Have a good day and bye-bye.
You too.